Hello, everybody. Welcome back to another episode of Finance Agents Live. Today is Finance Agents Live episode number 32. The numbers keep going up. Today I'm joined by David Krantz. And today's going to be a fun day for us. We're talking about something new, different than what we normally talk about, in the sense that normally we're talking about funding, how to get funding, or what kind of funding is available, or directly related funding services like credit report correction or payroll stuff for small business. Today we're going to talk about something different. It's Earn11.com.
Earn11 is a new investment fund. I'm not going to get into the whole thing because that's what we're going to be talking about today. But I've got David on. David, thanks for coming on the show. We appreciate it.
And today we're going to be doing, so next week, David is going to be interviewed at the Money Success Summit.
KRLA Wealth Summit in Anaheim, California.
Wealth Summit. KRLA, the answer. Wealth Summit.
By Larry Elder.
By Larry Elder, nationally syndicated. Larry Elder, right?
I think it's conservative talk show host.
Okay, great. Yeah, so we've been going over what questions he's going to be. We've sort of talked to him about what questions are going to be asked, and so we figured let's do a practice run on the questions, and at the same time, give you a chance to get a little peek inside as to what we're doing. So today we have, Lynn's hearing an echo there, by the way, so I don't know if you have, maybe I'm just talking too loud. All right, I'll talk a little less loud. But so today we have some questions lined up. These are the questions we're going to be asked during the event. I'm going to be there, looking forward to doing this. This is the first time I've gone to an event looking for investors. And so you may be wondering, why the heck is Tim getting involved in an investment fund instead of financing businesses or financing real estate? Well, it is related, and we're going to be talking about that now. So let's go ahead and jump right into this. And by the way, any time during this, if you guys have questions, throw it in there, and we can throw in some extra questions at David while we're at this. All right, so first of all, starting off, what is American Mortgage Fund?
American Mortgage Fund is an investment company that put together to return 11% return to our investors, secured by first trust deeds only.
11% return.
11% return.
That sounds pretty good to me.
Secured by first mortgages.
Secure, and it's a fixed return?
Fixed rate, fixed return.
Okay.
And what we've done is we do this in a couple different ways. We're a national mortgage company that's gone out there and buys loans from different mortgage brokers and different finance agents across the country.
Okay.
We invest in a particular class of loans that are all non-consumer loans. So we'll lend on a single-family home, to a vet clinic, to an apartment clinic, and everything in between.
Okay. Hold on. Darren, is it possible you get the mic on the computer? Because more people are saying there's an echo. You might want to check that. All right. So you'll buy mortgages on vet clinics, is what you said? All sorts of stuff.
Really, any type of property that we feel is going to have a good security and going to put my investors in a good, secure position.
Okay. So 11% is pretty good. How would you compare that to the other types of investments that are out there?
Well, let's just take a look at the stock market for one.
I mean, the stock market was down 1,175 points. I think it was Monday. Was down 666 points last week. Even though the stock market's been at a run, like everybody knows out there, you don't have to be a genius to know that sometime it is going to come down and crash.
What goes up must come down, right?
It's just a question of what and when.
Where the stock market's been going up for 10 years, 10 years, right?
4 really strong years,
yeah. I'm 4 strong, but literally I think we're at a 10-year run, right?
We're at a pretty high run. I don't know.
Long time.
And what you're going to find out is that as that market comes down, people are going to start to look for more secure investments that they can count on. And when you know each month that you're going to get 11% return in your mailbox or directly in your bank account, that's a pretty safe return, especially when you're lending on brick and mortar. You're not buying stock, which is really just a piece of paper.
Okay, all right. So it's an investment fund that pays 11% to the investors monthly, you said.
Monthly return.
And the type of investment fund is a fund that goes and invests in mortgages. Now, why don't you just buy properties instead of investing in mortgages? If I was investing, would it be better to invest in mortgages or buy houses?
It's really two different scenarios. And what we are is we offer a passive investment for investors that don't want to, I always call it the 2 T's, toilets and tenants.
What is that?
Toilets and tenants.
And what are
the 2 T's?
Yeah.
Toilets and tenants. If you don't want to be involved with toilets and tenants, and you want to get good return, mortgage investing is a lot easier than it is owning houses and becoming a landlord.
Okay.
It's
All right.
another way to be involved in real estate without having to get your hands dirty, collecting rents, and dealing with, like they say, with toilets and tenants.
Okay. All right, so let's go through the different types of investments out there. There's the stock market, which you could get more than 11%, but then again, you could lose all your money the next day. So this is definitely better because it's stable. Bonds. What are people getting on bonds?
You know, I think bonds are probably 4%. I think if you get a good municipal 30-year bond, you might be able to get 5% on a bond, maybe.
Okay. And Darren, are you seeing the comments about the echo goes away when you go to the slides and then it comes back when you go to me? If you look right there, you see the comments. Okay, so stocks goes up and down. Bonds is consistent, but it's way less.
Way less. Your money's tied up for a lot longer.
There's other mortgage investment funds that do loans like this, but they pay a lot less, right? I've seen them as low as 7%.
And the reason that we're able to pay higher is a couple of reasons. Number one is our business model. What a lot of my competitors do is they'll go out and raise money, and they'll let it sit into the mortgage fund and wait for the loan to come in. And that will bring their yield down because they're sitting on cash. We do just the opposite. We don't bring money into the fund until we have a deal to match it up with. So what we've done is we have credit lines that allow us to go out and put our loans on our credit lines. So right now, we have several $1 million worth of loans that are paying currently. And as money comes into our mortgage fund, we just pay off our credit line and put a deal into the fund.
Okay, so American Mortgage Fund, it doesn't buy one of these loans until it's already been done by somebody. So American Mortgage Fund isn't issuing mortgages. They're buying or investing in notes that are already existing and performing, is what you're saying.
That is correct.
Okay. All right, so that's different from... All right, so you got stocks, bonds, you got other mortgage funds that pay less because they just raise a bunch of money and then they try to figure out how to place it, is what you're saying. And then you got REITs, where they're actually buying properties. And what do you make out of real estate investment?
Well, real estate investment trust, a couple of things. There's no guarantee on what you're going to get as yield. They do, a lot of them do pay dividends, but they're a lot lower yield on the dividends. And it just depends on how it's structured, whether or not you're going to get that appreciation in time or not on a REIT.
Okay.
Because REITs are usually specified for a certain specific time, so they may be forced to sell their real estate at a bad time.
Oh, that's interesting. Okay. All right, so let's say I invest and get my 11% return. How is my investment secured? How do I know the money's going to be there next month?
Several different ways. Number one, we get title insurance on every one of our files. So you have a first lien position in the name of our company, which you're a member of.
Okay.
So we have a first lien security, secured with title insurance, and that's how you're secured. We put you in the banker's seat. So you have a first lien on the property.
So having a first lien is the key to being secured on a property.
That's right.
Okay. Isn't it also having to do with the loan to value, the amount that you loan versus the value of the property? Isn't that the key to securing the
LTV?
That's the number one thing,
The
right?
number one thing is the asset, thank you. The number one thing is the asset. On a commercial property, we limit our loan to values to what we call 55% LTV. And what that means is this. If the property is worth $1 million, the most we're going to lend is $550,000.
Oh, okay.
Giving you $450,000 worth of protective equity.
Protective equity. All right, so if a guy's got $1 million property with a $550,000 loan, he's not going to want to lose that property because of the loan. So he's going to do everything he can to make those payments. So that's what keeps you safe.
That's what keeps us safe. And then what we do to back that up is we have a first mortgage on that property with proper title insurance showing that we're in that first lien position.
Okay. What happens if the market tanks? What happens if property values drop? Could you end up getting
Property
those?
drops, I mean, even if property values drop by 25, 30%, you're still safe with us because we still have protective equity in there.
Okay. And I guess it's better than the stock market. If the stock market tanks, you lose money
The
immediately.
stock market takes you lose money right off the bat.
Okay. All right. So how do you end up getting started in mortgage lending? I mean, if you've been watching our show, you already know David, so you might have already heard his story a little bit, but if you're new, why don't you talk about how is it you get started doing
Well, I've
this?
been doing this for about 31 years. I'm a third generation money lender. Started with my grandfather, my father, and then myself.
We started in the city of Detroit, and
Yeah.
I always like to say when
Motor
I was,
City.
Motown. was 16 and got a car, it wasn't to go on dates with girls. It was to go chase mortgage payments, rent payments for my family. So as my father always said, you want. It was for a guy to buy a $4,000 water conditioner. It was my first loan I ever made.
Huh. Okay. Now, you don't really do those loans anymore because all the laws have changed and it's just crazy right now.
Right. All we do now is non-consumer lending.
Okay.
Commercial loans only.
Tell us about a typical investment. Like, maybe give us an example of one you've done recently.
Let's talk about a couple. I just did one where a lady just paid $150,000 cash for her house a couple months ago, and she needed to borrow. A couple months ago, and she needed to borrow some money to buy another property for her business. She's in a fix and flip business, and we lent her out $90,000 as a first mortgage against a $150,000 purchase price.
If she could buy these houses cash, why can't she go get a super cheap bank loan?
Okay, great question. Let me explain to you a couple of things. Number one, because of my credit lines, I'm able to give people loans in usually a 2-week period of time, where banks will take 2 months to get a loan done. So people are willing to pay a premium because we're so fast in getting them the money, number one. Number two, majority of my borrowers are self-employed. They're willing to pay a higher rate of return because we're getting the money quicker for them. They're using the money to make money, and it's cheaper than them bringing on a partner.
Okay. So if you're paying 11%, obviously the mortgages have to be higher than that, right? What's your average mortgage?
I would say our average mortgage is probably about 13.59% average.
Okay. How are you finding mortgages at 13.59?
Well, as I explained to you earlier, Tim, I've been in the business for 31 years. I have a network of people that know who I am and what I like, and they bring me loans. And then, of course, a relationship with finance agents and all the mortgage brokers out there. There's a whole market of loans out there that people are willing to pay low teen rates for because we're able to act quickly and we're able to move the money quickly for them, and it's still cheaper than bringing a partner on.
So that's a pretty sweet investment. You're almost 2-to-1 collateral on the loan, and it's high interest, so you're making good money and you're protected.
Right.
Right now, if you've been with us for a while, on business lending rates, if you're getting a loan at 13.5%, that's an amazing rate compared to working capital loans, or we have another real estate lender that we've seen people go to where they've had as much as a 200% APR. So it sounds crazy, but people are paying that, and then when they hear they can get such a cheaper rate on real estate, often they're ecstatic. So that's great. So tell us about another deal. So you had a lady bought her house cash. What's another one that you just did?
We just had a gentleman that runs an apartment building in East St. Louis, Illinois it's called.
East St. Louis, Illinois.
That's what it's called,
Okay.
East St. Louis, Illinois. He runs a, don't want to use the word flop house, but it's more of a drug rehab center, if you will, or people that go there that are sober living is what I think it is.
Sober living.
So I think it's a sober living home. He had it on a land contract for 3 years. He needed about $100,000 to buy out his land contract, and we gave him a loan. The property appraised for $240,000. We gave him a loan for $100,000.
Okay, so he had a contract to buy a piece of land at $100,000 that was worth $240,000.
No, the property was worth $240,000. He had a land contract.
What's a land contract?
A land contract's an agreement for sale. Same thing as an agreement for sale.
So he had a contract, he had an option to buy
He had an option
that
to buy
building.
Right, but he was already in that building.
He was already in.
Under a lease to own,
Okay.
if you will, under a lease to own.
Okay.
And then that lease to own came up where he had to come up with the $100,000 to buy the building, and we gave him the $100,000 to buy the building.
Okay, excellent. So, you're going to an investment summit, and people are watching this, they're thinking, well, I have 100% of my money to invest. I put some here, some there. What percentage of somebody's investment portfolio do you think they'd want to put into mortgage investing?
You're talking to the wrong guy, because I do 100% of my investments are in mortgages and mortgage lending of the sort. That's something that you have to feel comfortable with. There are investor friends of mine that do nothing but mortgages. Then I know investors out there that do nothing but bonds and stocks.
Okay.
I think when we talk to you individually, we can come up with a plan for you that makes the most amount of sense. I think this is one of the, if not one of the safest form of investments is first mortgages at these loan to values that we're at. When you're lending 55 cents on the dollar and 60 cents on the dollar of an appraised value, it's really going to take a lot to get hurt.
So why are you doing it so low? I mean, you think you could go to 75% and still have a lot of protective equity.
I've been doing
right?
this for 31 years. I've been through several different markets, and I know what I need to do to protect my investors from a down market.
Okay, so you're in for the long run, not
We're
the
in for the
short
long run, and truth be told, 70% is too high.
Yeah.
I think it's way too high, on a loan to value.
Okay. All right. Awesome. So we have some stuff here. Not that it's super important, but here's an example of the investment. But what are we looking at here?
Well,
I don't know if you can see this. Probably a little blurry, but
this is a folder, and inside our folder is we have a book that I wrote
uh-huh.
and a PPM, which
a
stands
book that you wrote, huh?
Yeah, how about that?
You wrote the book on
Roadmap.
mortgage investing.
Roadmap to Mortgage Investing
All
by
right.
David Krantz.
Okay,
That's
cool.
right.
So how would I get one of these books? You sell it on Amazon, $200 on Amazon, right?
Actually, it's $19.95 on Amazon, but call me, I'll give it to you for free.
All right, great. And then what is this? That's a big book
That's
right
a big
here.
book. This is from our attorney.
Leave it to attorneys.
Leave it to attorneys. This is what we call our private placement memorandum.
So what cost you more, to write your book or to write this one? I think it was this one. I know how much this one cost, and this was a lot of money to write.
A lot more to write that one.
Your time was cheaper than that. Okay. All right, well, this is interesting. We also got our business cards the other day, so getting ready for the investment thing. I don't know if you can see this, but behind us we have a big pop-up banner that we're taking with. All right, so we got a question. Lynn is asking, let's say somebody's interested in investing. Can anybody invest, or is there some limits? How much do you need to get in?
There's limits, and it really depends. So let me explain to you what that is. To go into our fund, you have to be what's called an accredited investor. What that means is that you must be worth $1 million minus your existing home or your primary home.
Minus your home. What's that?
Minus your home.
So if I got $1 million in the bank,
you qualify.
Okay. What's the minus the home mean?
You cannot use your home in considering whether or not you have $1 million net worth.
So if my home's worth $1 million and I got $10 in the bank, I can't do it.
You're not accredited.
Okay.
For our fund.
For the fund, right.
Right. Now, to be accredited for the fund, $1 million minus your house net worth, and or if you're single, $250,000 a year income. If you're married, it's $300,000 a year income.
For 2 years, right?
For
the last 2 years?
For the last 2 years, you are an accredited investor and can go into the fund. If you're not an accredited investor, we still have the opportunity to buy off individual trust deeds as well, too, or individual mortgages.
Oh, so if you're not an accredited investor, but you would still like to participate, then what?
You can buy individual mortgages from us.
What's that like? What if you don't have enough to buy a whole mortgage? Because, if you guys are watching this, our average loans that we're doing through Lentera are about $500,000. So
unfortunately,
who has $500,000 if they're not accredited?
Well, it's kind of the chicken.
Can you buy a part of one?
We do not sell partial mortgages.
No.
We do not sell partial mortgages.
Okay. What's the smallest mortgage that you guys would?
Right now, I think there's one there's one right now for $35,000.
35. Hey.
35,000 gets you in tow, and then the next one above that one is $85,000.
All right, so let's say you're accredited. Is there a minimum investment to get into the fund?
$50,000 will earn you 9%. $100,000 gets you the 11% and up.
Okay, so it's a different amount based on...
Right.
So as long as you put in $100K or more, you get an 11% every month.
Every month. No, a year.
Every month. I'm sorry.
You get payments.
11% annual, but you get monthly checks.
You get monthly checks.
So you get a little less than 1% every month.
That's correct.
Okay. All right. Stan is asking, can anyone on the webinar get free copies of the book?
You know what we'll do? The answer is yes.
Do you have the PDF?
I can PDF the book to you.
Okay. All right. So yes, if you're interested...
We started American Mortgage Fund for a couple reasons. Number one, we found it is a lot easier way to raise money, quite frankly, through a fund. We found it a lot easier for our investors to deal through a fund than it is individual transactions. And we made it up because it's just a much more passive way for investors to work.
Okay, so if you've been watching for a while, you know that Lentera, we're funding deals all the time. We fund it on our warehouse lines, and then we sell the loans off. So David's been selling off individual loans this whole time. And frankly, it's a lot of work selling off onesie, twosie deals. Also on the other side, the buyers, They're having to shop around and look at the different loans. By investing in the fund, it's way easier. They just put their money in, sit back. David does basically everything. And then they get their check in the mail. And Frank said they lost sound, but all right. It's back. Okay, it's back. All right. Good. Okay, so that's it. We'll go. Anybody else have any more questions? Can we get the PDF? Yes, you can definitely get the PDF. Just email tim@financeagents.com and we'll send it out to you. All right, well, that's it. We'll go ahead and wrap up this show. Come back next week for the Bankers Group. We were going to do it this week, but we had to do a delay. Next week is going to be an interview of a banker. We'll be talking to a banker about his experience and people coming to talk to him in order to get some feedback on, you want to hear directly from the banker, what's the experience like when people are coming in and proposing to have loans sent to them. So come back next week and we're going to have that interview. And then we'll go from there. Thanks everybody for coming on. If you're new to the show, like our video and subscribe to the show. Okay, so somebody is asking, are we wanting you guys to sell this investment? And unfortunately, no. I mean, I would love it if you guys could, but it's illegal, right?
Well, hold on. We'd love you for the referrals. Unfortunately,
right.
Legally, we cannot pay for those.
Okay, yes. Feel free to tell everybody you want about this. We would really appreciate that. We just can't pay you for it. But if you know people that are only making 5 or 6%, or maybe they made a lot of money in the stock market over the last 5 years and they're looking to cash out before they lose it all, and they wanted to put it into something else that's going to make them about the same return without the chance of a big dive, then refer them to us and they'll be appreciative of their referral. Maybe have them pay you. They're allowed to pay you.
Right.
We're not allowed to. So, all right, well, let's go ahead and wrap it up for the day. Thanks everybody for coming on. Make sure to come back next week. David, thanks for coming on the show. And we look forward to doing all of our deals together.